Now we're going to begin our final chapter of the semester, Chapter 17, where we'll cover inflation, the unemployment rate, and Federal Reserve policy. Now in this chapter, we're not going to go quite as in-depth as we have in past chapters, and I'm not going to include every single section. So we're going to ignore section 7.2, looking at the Phillips curve in the short run and in the long run. So we're going to begin this chapter by discussing the short run trade-off between the unemployment rate and inflation, which is called the Phillips curve relationship. Then we'll look at briefly at section 17.3. We'll look at the expectations of the inflation rate and how that affects monetary policy. And we'll give just enough background on that so we can understand section 17.4, Federal Reserve policy from the 1970s to the present. So for most of the Federal Reserve's history, the two great macroeconomic problems that it's faced has been unemployment and inflation. In fact, according to Congress, their mandate is to focus on the unemployment rate, keeping it as low as possible, and the inflation rate, keeping it low and steady. Now, when aggregate demand increases, unemployment usually falls and inflation rises, as we talked about last week. When aggregate demand decreases, the unemployment rate usually rises, and then the inflation rate falls. So as a result, we see there's this short-term trade-off between the unemployment rate and inflation. So when we have higher unemployment, we typically have lower inflation. Conversely, when we have a lower unemployment rate, we typically have a higher inflation rate. Known as the Phillips curve, named after A.W. Phillips, the first economist to identify this relationship. He first looked at Great Britain over a 50 or 75-year period and showed that there was a high correlation between the unemployment rate and the inflation rate, which he then extended to a bunch of other economies. Since that time, the graph that shows the short-term relationship between the unemployment rate and the inflation rate has been called the Phillips curve, named after him. So here, the figure on the right, we see a simple Phillips curve, where we have the inflation rate on the y-axis and the unemployment rate on the x-axis. So see at point A, when the inflation rate is 4%, the unemployment rate is 5%. When the inflation rate falls to 2% at point B, the inflation rate increases to 6%. So it highlights this inverse relationship between the unemployment rate and the inflation rate. Inverse relationship that Phillips found between the unemployment rate and the inflation rate is consistent with the aggregate demand and aggregate supply analysis that we developed in Chapter 13, if you remember that far back in class. So here we have two panels, one with the aggregate supply and aggregate demand, the other with the Phillips curve. So for simplicity's sake, for the aggregate supply aggregate demand model, we're going to assume that the long run aggregate supply curve and the short run aggregate supply curve do not shift. So we're assuming there's no change in the aggregate supply, either in the short run or in the long run. So we're only going to be shifting aggregate demand. So for this hypothetical example, let's assume that the short run equilibrium in 2019 is at point A. So we have a real GDP of $17.0 trillion and a price level of 110. Let's say there's weak growth in aggregate demand during the 2020 short run equilibrium. Again, this is pretending that there's no coronavirus to deal with. The short run equilibrium moves to point B. So we have real GDP of 17.3 trillion and a price level of 112.2. The inflation rate moving from the price level moving from 110.0 to 112.2 is 2%. And the unemployment rate is 6%, which corresponds to point B on the Phillips curve that we have in the panel on the right. Let's say there's strong growth in aggregate demand during 2020. Again, pretending there's no COVID in this example. Short run equilibrium moves to point C. So we have a real GDP of $17.6 trillion, and the price level increases to 114.4. So this strong aggregate demand growth results in a higher inflation rate. So we end up with an inflation rate of 4%. Looking at the Phillips curve, that inflation rate of 4% corresponds to an unemployment rate of 5%. So what our aggregate demand and aggregate supply model tells us is that when we have a greater increase in aggregate demand, what we're going to see is a higher inflation rate. And the higher inflation rate is going to be associated with a lower unemployment rate. Because we have this higher level of output, firms are going to need to hire more workers. But also, while this is going on, we're seeing an increase in the inflation rate. So by using our aggregate demand and aggregate supply model, we end up with the same relationship as we see from the Phillips curve. So our theory Working with the aggregate supply, aggregate demand model is borne out by the Phillips curve, which is plotting the actual inflation rate and unemployment rates. During the 1960s, after the Phillips curve became widely accepted by economists, some thought of it as a policy menu where you could look at the entire Phillips curve and choose a point on there where you could balance out the inflation rate and the unemployment rate. That's because they thought the Phillips curve was a structural relationship. So the basic behaviors of consumers and firms would remain unchanged over a long period of time. Structural relationships are very useful when you try to formulate economic policy because policymakers can anticipate that these relationships are constant, that over time, this negative association between the unemployment rate and the inflation rate is going to, persist. In the 1960s, this relationship appeared to be quite stable, and so economists used it as a policy menu where they can just choose different points along the Phillips curve. So they could trade higher inflation for lower unemployment, or they could trade higher unemployment for lower inflation, whichever they deemed more important and better for the economy. But in fact, it turned out this wasn't true, that allowing more inflation doesn't permanently lower the unemployment rate. In the late 1960s, simultaneously, although working separately, economists Milton Friedman and Edmund Phelps both argued that the Phillips curve relationship did not hold, and in the long run, we didn't have this trade-off between the unemployment rate and the inflation rate. They both argued that in the long run, the Phillips curve was vertical. So the Phillips curve, or the unemployment rate, wasn't determined by the inflation rate. While there seemed to be a correlation between the two, there was no causation going on between the two. The one didn't truly affect each other in the long run. That the unemployment rate was determined solely by output in the long run. The idea was that since employment must be determined by potential GDP, so must the unemployment rate, because that's the other side of the coin. So unemployment in the long run, according to Friedman and Phelps, goes to the natural rate, so when the output returns the potential GDP. That in the long run, you cannot push the unemployment rate below the natural rate of unemployment. Remember we talked about in the unemployment chapter that there's always going to be some structural and frictional unemployment in an economy, as it takes time for out-of-work workers to either find a new job that meets their skills or to obtain the skills to meet, the changing jobs that are needed in the economy. So because of that, there's always going to be some unemployment. And if you try to push the unemployment rate below that, in the long run, what you'll get is just higher inflation. You won't end up with lower unemployment below the natural rate for very long. So at this output level, at the potential GDP at that output level, there's no cyclical unemployment. So we're at the natural rate of unemployment. There's still that structural and frictional unemployment that's present. And these two cannot be affected at all by the inflation rate, which is why the natural rate of unemployment is going to be positive. There's going to be some level above zero. But Milton Friedman and Edmund Phelps' observations about the vertical long-run Phillips curve seem to contradict the experience of the 1950s and 1960s, which showed a stable trade-off between the unemployment rate and the inflation rate. But Milton Friedman argued that statistics from those years only showed a short-run trade-off. It didn't show this trade-off happening in the long run. Now, the reason he said the short-run trade-off appeared to exist but wasn't going to persist in the long run is that workers and firms sometimes expect the inflation rate to be higher or lower than it turns out to be. While we do have some idea, some anticipation of whether there's going to be inflation or not in the next year and whether it's going to be high or low, often workers and firms are wrong. So let's suppose that Ford and United Auto Workers, the union that represents the workers at Ford, agree to a wage of $34.65 per hour in 2018. Let's say they expect the price level to increase from 110 in 2017 to 115.5 in 2018, or 5% inflation. Then that $34.65 represents a real wage of $30. Now there's a lot of numbers on this table above, but it highlights what can happen if both the firm, Ford, and if the United Auto Workers, the union, doesn't anticipate inflation correctly. So with the anticipated inflation rate of 5%, that $34.65 per hour salary or wage comes out to $30 in real wages. when you account for the change in the inflation rate. Remember that workers and firms care about real wages over time, not nominal wages. They care about how much they can actually buy. So you want to account for the change in the price level. Let's say inflation is below that. It's actually 2%. So that's what the middle column here represents. If the actual inflation is 2%, then their real wages per hour, or for the workers, are going to be $30.88. So they're actually getting a raise of 88 cents per hour if the anticipated inflation rate is lower than both Ford and United Auto Workers predicted. Now, the final column shows if the inflation rate is higher than anticipated. If that's the case, then the wages per hour are going to be $29.17 instead of $30 per hour. So they're actually going to be losing money because the anticipated inflation rate was higher, or the actual inflation rate was higher than they anticipated. So if the expectations about inflation are correct, the real wage was going to be $30 an hour. So Ford is going to hire the planned number of workers. But if the inflation rate is lower than expected, the real wage becomes higher than it was expected, and Ford will have to adjust its hiring decisions. So they'll have to hire fewer workers for that year. On the other hand, if the inflation rate is higher than expected, the real wages are lower than was expected, and Ford will end up increasing its hiring because they're spending less on labor costs. So because of these anticipations that can be wrong, when they are wrong, this will give the appearance of a short-run Phillips curve relationship. So to summarize, if the actual inflation is greater than what was anticipated, then the actual real wage is less than what the expected real wage was. So the unemployment rate is going to fall. So if we have this higher inflation than was anticipated, we see lower unemployment. On the other hand, if the actual inflation rate is less than the expected inflation, then the actual real wage is going to be greater than the expected real wage. So we'll see an increase in the unemployment rate. Milton Friedman noted, there's always a temporary trade-off between inflation and unemployment, but there's no permanent trade-off. The temporary trade-off comes not from inflation per se, but from unanticipated inflation. All right, so how do these expectations of the inflation rate affect monetary policy? So how long the economy remains off the long-run Phillips curve depends on how fast workers and firms are able to adjust their expectations about the future inflation. So this is going to depend on inflation itself. So when the inflation rate is low, like it was during most of the 1950s and the early 1960s, during the 1990s, and during, the whole recovery since the 2007-2009 recession to even today, workers and firms tend to ignore it. It's not really a concern when it's, 1-2%. Now, when there's moderate but stable inflation, workers and firms are able to adjust fairly quickly. And this noticeable inflation is easily incorporated into expectations. So like during the late 60s and early 70s, the inflation rate in the US stayed between about 4 and 5%. It was high enough that workers couldn't ignore it without seeing their real wages, and firms would see their profits decline. But they could anticipate the next year's inflation fairly easily. So again, this wasn't a terrible situation for workers and firms because they were able to, anticipate the future. But for high and unstable inflation, so inflation rates greater than 5%, this is much more difficult to deal with. So forming rational expectations about future inflation becomes very important. It's essential for firms and for workers to understand and be able to accurately anticipate what inflation is going to be in the next year so that they don't have these changes in their real profits or their real wages. So firms and workers end up paying a lot of attention to forecasting inflation. This has been rare during peace times in U.S. history, but through 1973 through 1982, the inflation rate was of 5% every single year. It was also very unstable. So it went from 6% in 1973 up to 11% in 74, fell below 6% in 76, and rose to 13.5% in 1980. So it's all over the place, and it's very difficult to anticipate what the next year's inflation rate is going to be when it's bouncing around like that. So during this time, the value for workers and firms of accurately anticipating inflation is much higher than normal because of the large effects it can have on your real wages. So this leads to workers and firms forming what's called rational expectations. So expectations that are using all the available information about an economic variable. They take a lot of time and effort into forming these expectations. So there's two types of expectations that workers can have and firms can have. It's either adaptive expectations meaning that they expect the inflation rate in one period to be the same as it was in the previous period. And there's rational expectations, where workers and firms anticipate the Fed's policies, so they adjust their expectations about inflation accordingly. With rational expectations, monetary policy would have no short-run effect on employment. And the short-run Phillips curve is going to be vertical also. Because these workers and firms have perfect expectations about and perfect foresight about what Fed policy is going to be, so what the inflation rate and the unemployment rate is going to be. But if workers and firms have adaptive expectations, so they're anticipating the previous year's inflation, Fed policy can have an impact on the unemployment rate and the inflation rate. So we get that sloping short-run Phillips curve that policymakers and economists thought existed in the 1950s and 60s. So using the figure on the right, on the short-run Phillips curve, when there's adaptive expectations, monetary policy can have an effect in the short run. So you can move from point A to point B, so you increase the inflation rate and decrease the unemployment rate. However, if there's rational expectations, if workers and firms perfectly anticipate what the Federal Reserve is going to do and what we're going to see, the changes in the inflation rate and the unemployment rate, increasing the inflation rate through monetary policy is going to move up the vertical Phillips curve from point A to point C. So we end up with increasing the inflation rate, but no change in the unemployment rate. So Nobel laureates Robert Lucas and Thomas Sargent were big proponents of the rational expectations theory. So they concluded that the Federal Reserve could only affect output and unemployment through unexpected changes to the money supply. So only when there were unexpected changes, when there wasn't rational expectations, where firms and workers couldn't fully anticipate what the Federal Reserve is going to do because, they kept that knowledge a secret prior to their actions, only then could the Federal Reserve actually influence the economy. When they signaled their moves ahead of time, what their policy changes were going to be, workers and firms would incorporate that into their expectations about the future, so monetary policy could not decrease the unemployment rate. That the inflation rate would be anticipated, and it would be baked into salaries before the Fed even completed whatever policy change that was. Now, during the 1980s, some economists developed different mechanisms for explaining these changes in real GDP. The explanation was technology shocks, or changes in technology that increased worker productivity. So these technology shocks could push GDP above its previous potential level, improving economic output. Because this was based on real factors rather than just the money supply, but tangible things in the economy that are changing, these models became known as real business cycle models. So real business cycle models are models that focus on real rather than monetary explanations of fluctuations in GDP, focus on technology shocks, productivity improvements, things that are going on in the real world, not just policymakers influencing the money supply. Now, these real business cycle models assume rational expectations and that prices quickly adjust, rather than being sticky and slow to adjust. So when you combine the real business cycle models and Lucas and Sargent's rational expectation models are called new classical macroeconomics. They fall under the same basic category. Now we're going to look at Federal Reserve policy from the 1970s to the present. So we can use the Phillips curve graph to show how the Federal Reserve can permanently lower the inflation rate. So through the 60s and 1970s, Federal Reserve policy led to high inflation rates. And then actions by OPEC, the Organization of Petroleum Exporting Countries, this is the first time they began to flex their muscles, and they limited the supply of oil that they were providing to the market. That made the situation even worse and led to the stagflation, the terrible economy of the 1970s. So the graphs here show the U.S. economy in 1973. There's moderate but anticipated inflation, and you have unemployment at its natural rate. The economy is in fairly good shape at this point. The inflation rate's a little high, but not terrible, and it's anticipated and steady. So workers are able to incorporate that into their wage demands and wage negotiations. In 1974, OPEC reduces the supply of oil and it causes the price to rise dramatically. This is what's known as a supply shock, what we talked about in earlier chapters. So what it does is decrease the short-run aggregate supply curve. So it's going to shift that to the left. What we see is the price level increasing because the price of inputs for all these goods are increasing, and real GDP is going to fall because there's fewer goods being produced. The unemployment rate rose, but so did people's expectations of inflation because the price level is increasing due to the supply shock. So we end up with a higher short-run Phillips curve. The short-run Phillips curve, as we see in the panel on the right, shifts to the right or increases. So we have a higher inflation rate and a higher unemployment rate. This is thought to be impossible at this time, and this was really bad. Obviously, this is two bad things happening at once. You have a higher price level, so it's more difficult to pay for these goods and services. And also there's a higher unemployment rate, so you have people out of work. So the Federal Reserve was in a bind. It wanted to fight both inflation and unemployment, both bad things for the economy. But the short-run Phillips curve makes it clear to us that improving one only worsens the other. So what the Federal Reserve decided to do is implement expansionary monetary policy. So they tried to reduce the unemployment rate. But that comes at a cost of even higher inflation. And that's why we saw this runaway inflation in the late 1970s that spilled into the early 1980s. Because the Federal Reserve was trying to expand the money supply, trying to fight the high unemployment. So they're trying to increase aggregate demand in order to reduce the unemployment rate. But that comes with the side effect of a higher inflation rate. Now, it's not essential for you guys to be like memorizing the supply and demand graphs and like to work with these for the final exam. I'm using these in this chapter just to illustrate the changes that are going on. So I'm not just so much just waving my hand and saying this happened and this happened. So you have some sort of evidence for it. So use these as tools to remember what we're talking about and to make sense of what we're talking about, rather than things you need to memorize and regurgitate for the exam. By the late 1970s, the Fed had gone through 2 decades of continually increasing the growth rate of the money supply. So we have inflation continuing for 2 decades and increasing. The federal government tried several different methods to combat the rising inflation rate. They tried price controls. They tried actually limiting the goods that people could buy. Some of us, either us or our parents, may remember the gas lines in the 1970s where you were limited. You could only buy gas every other day based on your license plate. So there were long lines outside of gas stations of people waiting to fill up. Finally, Paul Volcker is nominated by Jimmy Carter as the chairman of the Federal Reserve. So he was convinced that the high inflation rates were damaging the economy, like pretty much everyone else was. But his goal was to come in and to break inflation's back. So that's exactly what he did, was enact contractionary monetary policy. So try to reduce GDP to reduce the unemployment rate, or reduce the inflation rate, which is going to have the effect of increasing the unemployment rate. And what we saw was in 1980 and 81 to 82, back-to-back recessions, where the contractionary monetary policy by the Federal Reserve severely limited economic output and increased the unemployment rate. The reason why both of these were necessary and why it took so long, why the Fed had to be contractionary for so long, is because inflation expectations had become unanchored. So people were anticipating the high inflation rate in the future. So it was self-reinforcing, these price level increases, because workers kept demanding higher wages, which comes out in higher prices for the goods and services. So for several years, the Phillips curve didn't move as these as people's expectations of future inflation remained high. Now, this isn't to say that people were not forming their expectations about inflation rationally. The Federal Reserve was announcing and it was signaling and it was enacting policy trying to reduce the inflation rate, but people were still anticipating a high level of inflation. The problem is that the Federal Reserve had a credibility problem. Over the past 2 decades, it had announced several times that it was going to enact contractionary monetary policy, so reduce the inflation rate, but increase the unemployment rate. But it allowed inflation to occur anyway. There were a couple times during the Nixon administration where Richard Nixon bullied the Federal Reserve chair into enacting more expansionary monetary policy, including famously to help his reelection chances in 72. But eventually, after several years of tight monetary policy or contractionary monetary policy, um, which increased the unemployment rate, eventually convinced people that the inflation rate was going to be lower, and prices began to fall, as so expectations of future inflation fell. So we see the figure on the right. We have the short-run Phillips curve. The first couple years, when expectations were still high, we moved along that Phillips curve, the short-run Phillips curve. Then, after people became convinced that the Federal Reserve was committed to this contractionary policy, we saw the Phillips curve shift down. So the entire curve shifted to a newer short-run Phillips curve. This table here shows the Federal Reserve Chair and the average inflation during their term. We can see that for Burns and Miller, so through the 1970s, the average inflation rate was quite high. We went from 2.2% from 51 to 70 to 6.5% from 70 to 78. And 78 to 79, we had 9.1% inflation, which is what Paul Volcker inherited. He was able, over his 8 years as Federal Reserve Chair, to get the average inflation rate down to 6.2% over his entire term. He was followed by Alan Greenspan. During his tenure, the average inflation rate fell to 3.1%. Alan Greenspan's term was called the Great Moderation for the very low inflation, for slow, steady growth, and for lack of recessions. Some called him the maestro because he engineered the first, what they called soft landing, where the economy, as the growth rate began to slow, the unemployment rate slowly began to increase. He adjusted monetary policy perfectly so that the economy never entered a recession. So growth continued. So it smoothed out fluctuations in the business cycle, which was a historic moment for the Fed, who had not been able to do that previously. Greenspan was followed by Ben Bernanke, whose average rate of inflation was 2.2%, so his was much lower, although much of his term coincided with the financial crisis and its recovery, so of course the inflation rate is going to be low. And finally, Janet Yellen. The average inflation rate during her term, the textbook has 0.09. It was higher. It was like 1.5%, I believe, a little bit higher throughout the entirety of her term. Again, this is because the recovery from the financial crisis, we've had low inflation since then. An important definition is disinflation. So it's a decrease in the inflation rate. So moving from 9.1% inflation to 6.2% inflation is called disinflation. Deflation is a negative change in the price level, so it would be an inflation rate of like negative 2%. Disinflation is when the rate is still positive, but the size of the percentage is decreasing. So moving from 9% to 6% to 3% is disinflation because it's still positive. So with the maestro at the helm, Alan Greenspan appeared very successful as chair of the Federal Reserve, especially when he ended his tenure at the Fed. So we had low inflation throughout his tenure, as I mentioned. Only 2 recessions. They were both short and mild, so in the very early 90s and the dot-com bubble in 2001. Increased the Fed's credibility. They followed through on their announced policy actions and basically continued Volcker's commitment to keeping inflation low and stable, which had not been the case for the previous 20 or so years. He also increased Fed transparency towards the end of his term, although Greenspan was famous for using very complex sentences and words and talking in circles to try to confuse reporters and Congress when he's testifying before Congress. Also during Greenspan's tenure, which is important to note, is that he de-emphasized the money supply as a Federal Reserve target for their policy. Paul Volcker changed the Fed's operating system to target the money supply because it was so closely linked to the inflation rate. Inflation is always and everywhere a monetary phenomenon, according to Friedman. Greenspan moved back to normalize monetary policy, so he focused on increasing the interest rates, and the federal funds rate in particular. And that's how the Federal Reserve focuses their policy today. There were some problems during Greenspan's tenure, which came back to bite us later. 2 in particular the textbook notes. The first is saving the hedge fund long-term capital management. They suffered very heavy investment losses in 98. They owed a lot of money to other firms. These hedge funds typically borrow short and invest long, so they invest in these long-term assets, and they borrow to cover their purchases or their daily operations from banks or from investors in the very short term, so they have to turn that money around quickly. When the value of their assets falls substantially, this puts them at risk to not being able to get new lenders. Makes it difficult for them to pay back their people withdrawing their accounts, or the people that they're like the banks they borrow money from to keep their operations going. So Greenspan, rather than risk letting a series of related firms fail, use the Federal Reserve to intervene and to help long-term capital management make these arrangements with their creditors, basically to unwind their investments slowly. So that he gave them time to prevent other firms from suffering a run. This seemed good in the short term. It prevented a lot of disruption in the financial markets, protected depositors and investors in these institutions to have them, not fail. But it set the precedent for helping these over-leveraged financial firms. By over-leveraged, remember that means these firms that borrow money to invest. That magnifies your profits, but also can magnify your losses when the value of assets falls. So this may have encouraged financial firms to take too many risks, knowing that they'll have the Federal Reserve as a backstop to help them unwind if something bad happens. And this is believed to exacerbate the financial crisis that happened in 2007, 2008. The second big mistake of Alan Greenspan is keeping the federal funds rate at 1% from June 2003 to June 2004. So in 2001, we had a mild recession with the dot-com bubble. By 2003, the recession was long over, but the Federal Reserve kept interest rates low anyway. The reason being is that at the time, the reading of the inflation rate was very low, so it was like below 1%. Because of that, Federal Reserve was worried about outright deflation. In my opinion, and some other economists' opinion, they shouldn't have, because these are productivity-driven deflation, which isn't a bad thing when prices fall because it becomes cheaper to make the goods. I mentioned at some point earlier in the course, it's when deflation is driven by decreased in aggregate demand, like the Great Depression, that you end up seeing that downward deflationary spiral. However, this doesn't matter for the discussion of 2003 to 2004, because it turned out the inflation rate was being mismeasured, and in the future there were revisions to the inflation rate that showed the inflation rate was at about 2%. So it turns out that short-term interest rates, the federal funds rate, was actually negative during this time, or the real interest rate was negative during this time. So interest rates throughout the economy were artificially low because most interest rates are based on the federal funds rate, a certain multiple of the federal funds rate, or 10% above the federal funds rate. So this, interest rates too low for too long may have encouraged borrowing that helped exacerbate the housing bubble. So these are the two things that Alan Greenspan may have failed on that led to the financial crisis, or increased the severity of the financial crisis. During the financial crisis, because of the depth and the severe damage done to the economy, the contraction in GDP and the high unemployment rate, Federal Reserve moved the federal funds rate target down to what's called the zero lower bound. They moved it down to zero, and at that point they couldn't go negative. That was not a policy option for them. So because they were out of their traditional tools, they had to open up their toolbox and try new things. One of the things they tried was what's called forward guidance. Basically, they would tell the public what future monetary policy is going to be. What this is done to do is to affect people's anticipated inflation. The goal is to help put upward pressure on inflation, so you can increase wages, and we'll slowly begin to increase GDP and increase employment, or decrease the unemployment rate. Investors began to use forward guidance and incorporate that into their decision-making process very quickly. Here's an example of a Fed statement at the very beginning of Janet Yellen's term. We see the interest rate on 10-year Treasury notes spiked after 2 p.m. when the announcement was made, going from 2.7% up to about 2.76%, which seems like a very small amount, but this is changed based solely on a statement made by the Federal Reserve Chair at the time. During the financial crisis, the Fed adopted what's called a too big to fail policy, meaning that some financial institutions were so systemically important, they were so interconnected with other banks, that by letting them fail, it would bring down all these other financial institutions. So it would wreak havoc on the financial system. And not only would it, hurt banks, hurt their profits or bottom lines, whatever. Remember, this also hurts depositors, regular people that either have their pensions like invested through investment banks, or people that have bank accounts that would, no longer be able to access their money because the bank didn't have enough assets on hand to pay back all the depositors. That this damage to the financial system has serious consequences for the real economy. So the federal government will not allow these large, deemed systemically important or too big to fail firms to actually fail. The Wall Street Reform and Consumer Protection Act, usually called the Dodd-Frank Act, prohibited the Fed from making loans for the purpose of assisting single and specific company to avoid bankruptcy. So there's some concerns that the Federal Reserve is not allowed to maintain this too big to fail policy when they've basically guaranteed this policy to continue through their actions, starting with long-term capital management, but coming up through the financial crisis and the number of firms that they helped save or they helped purchase toxic assets to make sure that rather than going bankrupt, some other investment firm bought that failing financial institution. I'll end by just touching briefly on some proposals for future changes to the Federal Reserve. A lot of policymakers in Congress want to make some sort of change to the Federal Reserve. There's a bunch of different alternatives out there proposed by either politicians or by economists. Some are requiring the Fed to adopt a formal policy rule. So rather than giving them the discretion to choose what inflation rate they want to target, how they want to go about meeting those targets, to have a formal rule so people know what's going to happen. The most famous rule is by John Taylor from Stanford, called the Taylor Rule, which combines the unemployment rate, the inflation rate, the GDP growth, and uses that to target the federal funds rate, which the Fed had followed fairly closely throughout Greenspan's tenure. Another proposal is making price stability the Fed's sole policy goal. So having the Federal Reserve ignore the level of employment. Another is changing the Fed structure to alter the membership of the FOMC or to add new Federal Reserve district banks. So one of the problems is District 12, which covers California and the whole Western United States, was designed. All the districts were laid out in 1913, but we've seen substantial population changes. So some believe there's no reason that Cleveland, Ohio should be a district and then Philly should be a district. We could combine what's basically Pennsylvania, Jersey, and Delaware in the Philly district, and Ohio, part of Western Pennsylvania, and part of Kentucky in the Cleveland district. They can just be combined into one district, and we could split out West, which has had huge population growth, into at least two districts. So basically changing the districts to meet the changing demographics and the population makeup of the United States. And finally, there are some calls to audit the Federal Reserve's monetary policy actions, audit the Fed's balance sheet to see what assets they actually hold, and add more congressional oversight and decrease Federal Reserve independence so that Congress or the President would have more control over the Federal Reserve's policy actions. And I'll end by noting that independence is a very important feature for a successful central bank. So Larry Summers and Alberto Alesina did a study showing the importance between the inflation rate and the degree of independence of the central bank. When the central bank does not have independence from lawmakers, what we end up seeing is that the central bank enacts monetary policy with political goals. So they end up, trying to lower the unemployment rate, thus increasing the inflation rate in the lead up to elections. Famously, Richard Nixon is on tape threatening the Federal Reserve Chair, trying to bully him into engaging in expansionary monetary policy on the eve of his reelection, or I guess about a year before. Richard Nixon showed surprisingly deep knowledge of monetary policy, talking about the long and variable lags, phrase that Milton Friedman was using at the time. Basically, he told Burns, I know there's going to be inflation in the future, but right now, if you engage in this expansionary policy, you'll lower the unemployment rate for me on the eve of the election, and it'll help me get reelected. When we don't see independence of these central banks from members of Congress or from the president, what we end up seeing is that they do things like this to try to help those politicians get elected because, the politicians have much more oversight in this case, so they're able to effectively threaten or bully the central bank into helping them out. So it's important for the monetary policy for it to be designed correctly if you're not worried about these short-term political needs, rather focused on long-term macroeconomic objectives like price level stability and low unemployment.